Definitely, there's a lot of uncertainty around the world, while on one hand is the US markets which are seeing no stopping, and some of these Asian peers are doing very well. But what's the sentiment looking like, and what's the outlook going ahead on the global markets as well as the big strategy for India? Let's understand more on that, and let me welcome Mr. Mike Coop, Chief Investment Officer of EMEA Morningstar Wealth, joining us on the show. Hi Mike, so good having you on the channel today. Thank you so much for your time. And firstly, in a market where the macro cues keep sending mixed signals, how can investors strike the right balance between staying disciplined and staying adaptable? Help us with your view on that.
They should stop listening to macro signals to start with, because most of those are noise and don't help you make good long-term investment decisions. So I think you're better off making sure you have a good idea what price you should pay to own equities, to own bonds, and use that as your guide in terms of whether prices are above or below that, rather than relying on macro forecasts.
All right, point noted. But Mike, now with geopolitics shifting, trade patterns realigning, and even central banks taking divergent paths, how are these dynamics reshaping the global asset allocation strategies today?
Well, I don't know they really are changing people's asset allocations. The main thing that we've observed is that people have woken up to how much exposure they have to the US economy, the US dollar, the US bond market and the US equity market, and some of those have responded by hedging some of that exposure they have to the US dollar, and some of them are starting to think about whether they need to have more of their assets outside the US, but I don't think there's a sea change there. It's really just at the margin.
All right, but Mike, are we witnessing a structural move towards regional diversification, or does the US still remain the anchor of the global equity markets?
From what we can see, it still dominates as a global equity anchor, because people tend to follow the markets that have done the best. And that's the strongest link we can find between the flow of money as a driver. It's really the recent past. So AI has taken another move up, and that's meant that AI-themed investments everywhere have gone up. So people who are attempting to compare themselves to a benchmark and beat the benchmark are suddenly finding that AI doing well again is making it harder for them. So I think we're not at a point where people have really moved heavily away from that way of managing their finances if they're a professional. And some of the retail investors naturally also follow on from that in terms of wanting the most in-demand investments, and the most in-demand investments have tended to be AI-themed.
All right, interesting points there. But Mike, we have seen fresh inflows into the emerging markets, right? Are you still constructive on India? That's my question, because India, everybody talks about the rich valuations. What is your take on that? And do you see other emerging markets more compelling right now?
For us, we see Korea and Brazil as more attractive at the moment. I think the heat is starting to come out of the Indian market a bit compared to other markets, but at the moment we don't see India as a particularly attractive proposition. We did like China about 18 months ago. It was trading very cheap with good quality businesses and improving fundamentals, and that's still the case today, but with much less upside than 18 months ago.
All right, Mike, but many investors underperform the very funds they invest in. What behavioral gaps cause that? If you can help us with your take on that, and what simple guardrails can help them stay on track?
That's a great question. So studies on this mind the gap analysis demonstrates that returns are lower when you take into account investor flows in and out of different funds. And that's because of biases that we all have. So we'll give you a couple of the key biases. One is recency bias, which means that when you think about the future, you tend to overemphasize the likelihood of what's just happening again. So when things are really bad, people, all they can think about is how bad things are. When things are good, all they can think about is how good they are. So people tend to extrapolate, and that means they chase markets, and when markets have moved up a lot, they put more money in once the markets already become expensive and overpriced. And the quid pro quo is if markets fall, they tend to be more likely to take their money out. So that recency bias, along with confirmation bias, where you tend to seek out opinions that concur with your own, mean that you tend to be subject to these extremes in mood. So the way to break that is to try and have a research foundation for your investments, to think not about the recent price move, but to think about whether the price is below or above what you think you should pay for it. And we found that to be a very effective way of dealing with those biases you mentioned.
All right, Mike, with this, we let you go on that. Thank you so much for taking the time out and speaking with us. All right, but with this, let me now welcome on board Laura Luton, who's the Global Head Manager Research at Morningstar, joining us on the show. Let's try to decode what's in for the markets in the times ahead. What are the big triggers that could likely be in the store? Hi, Laura. Great to have you on the channel. Thank you so much for joining us. And the first question with respect to investor preferences, they are clearly evolving. Help us understand what are the biggest global trends that you are noticing in how capital is being allocated across active, passive, and alternative strategies.
So globally, we've seen an increase in passive investing. It's especially true in the U.S. market, where flows to passive have been strong. But we've seen a lot of new passive strategies launch in India as well. So this is definitely one of the strongest global trends that we're seeing.
Yes, of course, Laura, people are now shifting to passive investing, not a trend that we are following in India, but globally, that's a big trend in making. But given that rise, Laura, where do you still see a strong case for active management? And how are successful managers differentiating themselves today?
So Morningstar has compared active and passive investments across all sorts of asset classes over the years in markets all over the world. And we have found that in very transparent, heavily traded types of investments like U.S. equities, passive has outperformed active. When you get into the less transparent areas like fixed income, emerging markets, that's where active has a better chance at outperformance.
All right, well, Laura, semi-liquid alternatives have been gaining real traction lately. What's driving this demand, and what should investors watch out for when it comes to the risk and the liquidity trade-offs?
So the demand for semi-liquid strategies is being driven by a couple of things. For one, investors, retail investors, are interested in getting access to the strong return streams that they've seen coming from private credit, private equity, and other alternatives in recent years in the markets. So semi-liquids would give them access to those return streams. The other thing that's driving this trend is coming from the asset managers on the private side. They have traditionally courted institutional investors for the most part, but institutional investors have declined their interest in private investments starting back in about 2021. And so to grow their private investment portfolio, they're turning to retail investors. Now, in terms of the attributes that you can consider when choosing a semi-liquid strategy, some of the things that we look for are experienced management, a well-established investment process, and a parent company, an asset management company that has a strong track record for caring for investors' capital. Those are important attributes. I think it's also important for investors to check on the cost. Semi-liquid funds tend to be far more expensive, sometimes 3 times more expensive than you'd be paying for a liquid equity or credit fund. So if you're going to make a long-term investment in a semi-liquid fund, you want to make sure you know what you're investing in and you're comfortable with those terms over a period of years.
All right, well, Laura, in Morningstar's global framework, how has the definition of quality fund managers evolved beyond just performance metrics?
When choosing a manager globally, there is a framework that Morningstar has used for years where we look at the investment process, the people running the strategy, and the parent company that's offering the fund. I think one trend that's gained traction is an attention to price. So price is often the most predictable data point in terms of future performance. So if you stick with low-cost offerings that have solid management, repeatable investment processes, and parent companies that treat shareholders well, you're going to be in a good spot.
All right, well, Laura, as you scan the global markets, what long-term themes or structural shifts do you think will shape the next decade of fund management for both investors and asset managers?
So I think over the next decade, we're going to see a lot of interesting market activity. That's how the markets always work. There are ups and downs. Obviously, the technology sector has been white hot in recent years, and it will be interesting to see if the earnings keep up with those expectations. If not, I think we'll see a rotation elsewhere in the economy.
All right, but Laura, given your global client lens, where are investors showing stronger conviction right now? Is it towards the emerging markets like India or China, or what's driving those preferences?
So the Morningstar Emerging Markets Index tracks a number of developing markets, and in Asia, China, and India are both included in that. In recent years, the exposure to China and India have both declined. India was on an upward slope until about a year ago, and then some valuation concerns brought its weight down in the index. We're seeing far more enthusiasm for India on the fixed income side. Fixed income funds are net inflows year to date. That's in part due to JP Morgan's increase of India in its index. Was entered into the index at a 10% weight. We see fixed income managers who are interested in emerging markets and equity managers as well, not quite meeting that 10% threshold that JP Morgan has suggested in its index, but we see strong response to Asian markets, particularly India and China, in benchmarks that track emerging markets.
All right, well, Laura, lastly, we are also seeing a growing tilt now towards self-reliance, with economies like India looking inward. How do you see this trend playing out, and what could it mean for the US and the broader global economy?
So I think the short and long-term global economics picture is a little muddy, and we would encourage investors here at Morningstar to really look long-term. So whether countries like India decide to turn inward and become more self-reliant, and we see that in other countries, if you're in a well-diversified portfolio with strong managers that have yielded good results in the long term, you should see the same in your portfolio, and that will hopefully negate any concerns that you might have about the short term.
All right, Laura, with this, we let you go on that. So good having you on the channel today.